It wasn't a mistake. It wasn't a political error. It wasn't even a failure of imagination. It was a mathematical inevitability. The trap does not care about intentions. It does not care about political parties. It does not care about the credentials of the people in charge. It only cares about arithmetic, and the arithmetic is merciless. We are told that the central bank is steering the ship, that they are carefully weighing the data, that they are balancing employment against inflation, that they have a toolkit full of precise instruments. But this is a comforting fiction. The reality is much darker. The reality is that the ship has already hit the iceberg. Thus, water is already taking on weight, and the captain is merely deciding which compartments to flood first. They have 3 levers left. They can raise rates, they can cut rates, or they can hold rates steady. In a normal cycle, one of these options leads to safety. In a trap, every option leads to a crisis. If they raise rates to fight inflation, they bankrupt the sovereign and crash the banking system. If they cut rates to save the banks, they reignite inflation and destroy the currency. If they do nothing, the stagflation grinds the middle class into dust. There is no door marked exit. There is no path marked soft landing. There is only a choice between immediate pain and delayed agony. The pattern is unmistakable. It is not new. It has happened to empires of gold. It has happened to republics of paper. It has happened in the ancient world. And it has happened in the modern era. The mechanics are identical. The incentives are identical. And the outcome is identical. To understand why the Federal Reserve is paralyzed today, we must look at the ghosts of the past. We must look at the men who stood exactly where the central bankers stand now. Men who thought they could outsmart the math. Men who thought they could print their way to prosperity. Men who found out too late that debt is a prison from which there is no escape. History provides us with 3 perfect case studies. 3 moments where the trap snapped. Shut 3 civilizations that faced the impossible choice. The first is the Roman Empire during the crisis of the 3rd century. The second is the Weimar Republic in the years following the Great War. The third is the British Empire in its long, agonizing twilight. Just like the Roman Empire, we face a bloated military and a debased currency. Just like Weimar Germany, we face a sovereign debt load that cannot be paid in honest money. Just like the British Empire, we face the loss of reserve currency status and the humiliation of external constraints. The pattern repeats, the trap is set, and the arithmetic is waiting. The story begins in Rome. We often think of the Roman collapse as a sudden event, a barbarian invasion that toppled the gates overnight, but the rot began centuries earlier, not on the battlefield, but in the mint. The crisis that nearly destroyed the empire in the 3rd century was not primarily military, it was monetary. The trap was laid by the emperors who believed they could violate the laws of economics to fund their political ambitions. Consider the silver denarius for centuries. This coin was the standard of value across the known world. It was the dollar of antiquity. Under the Emperor Augustus, the denarius was almost pure silver, roughly 95 to 98% pure. It was sound money. A soldier knew that his pay had intrinsic value. A merchant in Syria knew that a coin minted in Rome would hold its purchasing power. His stability allowed for the Pax Romana, a period of flourishing trade and relative peace. But stability breeds complacency, and complacency breeds excess. The costs of maintaining a global empire began to mount. The legions required payment, the bureaucracy required funding, the public required bread and circuses. The emperors, facing the eternal political constraint of wanting to spend more than they taxed, found a shortcut. They began to debase the currency. It started slowly. Nero, facing a budget shortfall, reduced the silver content to roughly 90%. It seemed like a harmless adjustment. The coin looked the same. It weighed nearly the same. Who would notice a missing 5% of silver? The incentive was irresistible. By mixing in base metals like copper, the emperor could mint more coins from the same amount of silver. He could pay his bills without raising taxes. He could kick the can down the road. But the road eventually runs out. By the time of Septimius Severus in the early 3rd century, The silver content had crashed to barely 50%. Severus, military strong man, understood his power base. On his deathbed, he gave his sons a piece of advice that sums up the philosophy of the trapped ruler. Be harmonious. Enrich the soldiers and scorn all other men. To enrich the soldiers, his successors had to destroy the currency. They had no choice. The army demanded higher wages to keep up with the rising prices caused by previous debasements. To pay those higher wages, the emperors had to debase the coin further. It was a feedback loop of destruction. By the year 260 AD, the silver content of the denarius had fallen to less than 5%. The coins were essentially copper slugs, washed in a thin layer of silver that rubbed off after a few exchanges. Imagine the life of a Roman centurion in this era. He receives his pay, but the coins are worthless. Merchants refuse to accept them at face value. The price of wheat has skyrocketed. The price of land is denominated in gold, which he does not have. He is technically a millionaire in denarii, but he is. Starving the government, realizing its money is worthless, begins to demand taxes in kind grain cattle and labor rather than in its own coin. The monetary economy collapses into a barter economy. Trade grinds to a halt. The complex supply chains that fed Rome disintegrate. The empire fractures into three warring pieces, not because of a lack of swords, but because of a lack of sound money. Just like Rome, the Weimar Republic found itself caught in a trap of its own making, but at a speed that terrified the world. The tragedy of Weimar Germany is often simplified into a story of stupidity, but it was actually a story of constraints. The men in charge were not fools, they were trapped. Following the defeat in a world war, one Germany was saddled with the Treaty of Versailles, which imposed crushing reparations payments denominated in gold marks or foreign currency. At the same time, the domestic government faced a fractured society, returning soldiers, and a desperate need for social spending to prevent a communist revolution. The head of the Reichsbank, Rudolf Havenstein, faced a dilemma that mirrors the modern central banker's nightmare. The government was running massive deficits. It could not raise taxes because the economy was shattered and the political will was non-existent. It could not borrow from international markets because it was a pariah state. The only remaining option was the printing press. Havenstein chose to print. He believed that by providing liquidity, he was keeping the economy alive. He argued that without the printing press, the government would default. Civil servants would go unpaid, and the country would descend into civil war. The incentive was clear print money to buy time. The pivotal moment came in 1923. French and Belgian troops occupied the Ruhr Valley, Germany's industrial heartland, to enforce reparations payments. The German government responded with a policy of passive resistance, ordering workers to strike. But striking workers still need to eat. The government committed to paying the wages of millions of idle workers. With no production and massive spending, the dam broke. The arithmetic took over in January 1923. A loaf of bread cost 250 marks. By September, it cost 15 million marks. By November, it cost 200 billion marks. The printing presses could not keep up. The Reichsbank began utilizing private printing firms, turning out notes with denominations of trillions. Consider the human cost of this arithmetic. A university professor who had saved his entire life for a comfortable retirement found that his life savings could not buy a cup of coffee. A widow who had sold her large house for a fixed sum found herself destitute weeks later. But conversely, those who had borrowed heavily to buy real assets, industrialists, speculators, farmers with mortgages, saw their debts wiped out instantly. The inflation was a massive transfer of wealth from the prudent saver to the reckless borrower. The middle class was radicalized. They had followed the rules they had saved. They had trusted the institutions and for their loyalty. They were liquidated. The social contract was broken. When the money dies, the society dies with it. The chaos of 1923 did not immediately bring Hitler to power, but it destroyed the moral legitimacy of the Republic. It taught a generation of Germans that democracy meant poverty and that stability required a strong man. The trap of 1923 laid the foundation for the horror of 1933. Just like Weimar, The British Empire faced a slow, agonizing suffocation under the weight of debt and the defense of a currency that was no longer supreme. The British experience is perhaps the most relevant to the modern American situation because it was not a sudden hyperinflationary collapse, but a decades-long decline known as stop-go after World War II. Britain was exhausted and heavily indebted to the United States. Yet it tried to maintain the illusion of imperial power and the reality of a generous welfare state. It wanted to maintain the pound sterling as a global reserve currency pegged to the US dollar. This created the trap. To defend the pound's value, the Bank of England needed to keep interest rates high and run budget surpluses. But to maintain full employment and fund the National Health Service, the government needed to keep interest rates low and spend money. These goals were mutually exclusive. Every time the economy grew and unemployment fell, imports would surge, the trade balance would worsen, and the pound would come under pressure. The markets would sell sterling. To defend the peg, the government would have to slam on the brakes, raising rates, cutting spending, and inducing a recession. This was the stop. Once unemployment rose and the currency stabilized, the political pressure to grow would become unbearable. The government would cut rates and boost spending. This was the go. This cycle repeated throughout the 1950s and 1960s, eroding British industry and confidence. The trap tightened in 1967. Prime Minister Harold Wilson, who had famously promised to protect the pound, was forced to devalue sterling by 14% against the dollar. In a broadcast to the nation, he uttered the infamous line, "This does not mean that the pound here in Britain, in your pocket or purse, or in your bank has been devalued." It was a lie. A devaluation of the currency is an immediate reduction in the standard of living for a nation that imports goods. Prices rose, living standards stagnated. The trap had not been escaped. It had merely been reset at a lower level. The ultimate humiliation came in 1976. Inflation in Britain had hit 24%. The government was struggling to borrow. The markets had lost all faith in sterling. The United Kingdom, the former master of the globe, was forced to go hat in hand to the International Monetary Fund for a bailout. The conditions were harsh, brutal spending cuts, higher interest rates, and a surrender of economic sovereignty. The empire was gone. The pound was a second-tier currency. The trap had claimed its victim. The pattern repeats in 7 distinct stages. Stage 1 is sound money. The nation is rising. The currency is backed by hard assets, gold, silver, or dominant industrial production. Debt is low. The government lives within its means. Prosperity is built on savings and investment, not consumption and credit. Stage 2 is overextension. The nation becomes a victim of its own success. It takes on global responsibilities. It builds a massive military. It creates expensive social programs. The political class promises more than the economy can naturally sustain. To bridge the gap, they begin to borrow. Stage 3 is the first debasement. This is the turning point. The debt burden becomes noticeable. The interest payments begin to crowd out other spending. The government faces a choice: austerity or manipulation. They choose manipulation. They lower interest rates artificially. They decouple the currency from hard assets. They introduce a temporary measure to increase liquidity. Stage 4 is inflation and the false boom. The easy money flows into the system. Asset prices rise. The stock market soars. Real estate booms. The government looks like a genius. People feel rich because their portfolios are up, even though their purchasing power is stagnant. This is the era of the soft landing narrative. Stage 5 is the trap. This is where the arithmetic takes over. Inflation moves from assets to goods and services. The cost of living spikes. The central bank tries to raise rates to fight inflation, but they find they cannot raise them high enough without crashing the debt-laden economy. They are trapped. If they hike, they cause a depression. If they pause, inflation runs rampant. Stage 6 is the crack-up boom and flight to real assets. The public loses faith in the currency. They realize the government has no exit strategy. Smart money flees bonds and cash. They buy land, gold, commodities, art, anything that cannot be printed. The velocity of money accelerates. The middle class, holding cash and pensions, is wiped out. Stage 7 is the reset. The system breaks. A new currency is issued. Debts are restructured or defaulted upon. The wealth transfer is finalized. The cycle begins again from the ashes. Just like Rome, just like Weimar, and just like Britain, the United States is now deep in Stage 5. The data is unambiguous. The Federal Reserve is trapped. Consider the constraints. The U.S. federal debt stands at over $34 trillion. The debt-to-GDP ratio is over 120%, a level that historically guarantees default or high inflation. For decades, the Fed could raise interest rates to 5 or 6% without breaking the budget because the debt was manageable. Today, every 1% increase in interest rates adds hundreds of billions of dollars to the annual deficit. We are currently spending more on interest payments on the national debt than we spend on the entire defense budget. Think about what that means. We are borrowing money just to pay the interest on the money we already borrowed. This is the definition of a Ponzi scheme. The Fed knows this. They know that if they keep rates high to fight inflation, the interest expense will spiral out of control, forcing the Treasury to borrow even more, which requires the Fed to print money to buy the bonds, which causes more inflation. This is the fiscal dominance trap. The central bank loses control of the money supply because the government's fiscal deficit is too large. But consider the alternative. If the Fed cuts rates to save the government and the banking system, they unleash the inflation psychology that they have spent 2 years trying to crush. The supply of goods is still constrained. The labor market is still tight. A premature rate cut signals to the market that the Fed has surrendered capital, will flee the dollar. Commodities will spike. We will replay the 1970s, but with higher debt and a more fragile society. Some observers argue that the U.S. is different. They say the dollar is the world reserve currency, and therefore the U.S. can borrow indefinitely. They point to the exorbitant privilege. This argument ignores the mechanism of the trap. The reserve currency status is not a magic shield. It is a dam that holds back the flood when the dam breaks. The flood is more catastrophic, not less. The world is already diversifying away from the dollar. Central banks are buying gold at a record pace. The BRICS nations are trading in local currencies. The demand for U.S. treasuries is softening. The privilege is eroding. Under these constraints, the rational move for the Fed is to choose the path of financial repression. This is the endgame of controlled decline. In a controlled decline, the government keeps interest rates below the rate of inflation. This is negative real rates. If inflation is 5% and rates are 4%, the real value of the debt shrinks by 1% every year. It is a slow-motion default. It is a tax on savers, retirees, and wage earners. It allows the government to liquidate its debt, burden at the expense of the citizenry. This was the strategy used by the U.S. and U.K. after World War II. But there is a risk. Financial repression requires a compliant population and a closed system. In the digital age, capital is mobile. If the repression becomes too obvious, capital will flee, triggering the chaotic collapse. The chaotic collapse is the Weimar scenario. The bond market revolts, yields spike uncontrollably. The Fed is forced to monetize the entire debt, printing trillions in a matter of months. The dollar loses 5060, or 80% of its value. Supply chains break, social order frays. This is the outcome the system is desperate to avoid, but the trap makes it a non-zero probability. The final outcome is the reset. This is not a conspiracy theory. It is a historical regularity. When a currency fails, it is replaced today. The infrastructure for this reset is being built in the form of central bank digital currencies, CBDCs. A CBDC allows the central bank to bypass the commercial banking system, deliver stimulus directly to citizens, and potentially implement negative interest rates to force spending. It is the ultimate tool of control, and it is the logical conclusion of a system that has run out of road. The transition from the current system to the next will not be painless. The wealth that is stored in paper assets, bonds, savings accounts, annuities, is at risk of being inflated away or legally encumbered. The wealth that is stored in real assets, productive land energy. Precious metals essential businesses will survive, though its nominal price will fluctuate wildly. The only variable is timing and pain. The trap has been set for decades. The trigger has been pulled. We are simply watching the bullet travel in slow motion. This is not a call to panic. It is a call to attention. The era of easy money and passive investing is over. The era of volatility and active preservation has begun. Education is your primary asset. Resilience is your primary hedge. Watch the data, not the headlines. Subscribe to continue this analysis. Prepare your mind. Prepare your household. The arithmetic will not wait.